My name is Ronnie Michael, certified public accountant, and this is the Personal Finance Playbook. Improve your finances, improve your life. The title of today's episode is Explain Like I'm Five, Tax Withholding on Your Paycheck. Let's say you make $52,000 a year, and let's say you get paid every 2 weeks, so 26 paychecks in a year. You're probably aware that you aren't actually going to get $2,000 deposited in your bank account with each paycheck. It's because of taxes, right? Taxes do indeed come straight out of your paycheck. But have you ever wondered how much in taxes get taken out or what type of taxes? Let's find out. There are two key concepts to know when it comes to understanding your paycheck: gross pay and net pay. Gross pay is your earnings before withholdings for taxes and benefits. When you accept a job offer, the stated salary in your offer letter is the gross pay for your job. Bonuses, stipends, and other sources of income may also be a part of your earnings. Net pay is your earnings after withholdings for taxes and certain benefits, like health insurance. This is the amount of cash that you're actually able to deposit in your bank account. Taxes are withheld from your paycheck. Withholding means that your employer holds the money and sends it to the appropriate place without you ever having a chance to possess the money. Your employer withholds money for federal income taxes and then sends it directly to the IRS. There are three main types of tax withholding: income taxes, Social Security, and Medicare. Income taxes are collected to fund the general operation of governments. Income taxes can be assessed at three different levels: federal, state, and local, where local typically means a city or a county. Everyone is subject to federal income taxes. Everyone is also subject to state income taxes, except for the people who live in the 9 states that do not actually have a state income tax. These include Alaska, Florida, Nevada, South Dakota, New Hampshire, Tennessee, Texas, Washington, and Wyoming. And some people will be subject to local income taxes. For example, residents and people who work in the city of San Francisco are assessed a flat income tax, in addition to any state or federal income tax. Federal income taxes and many state and local income taxes are not simply a flat percentage of your income. These income taxes typically follow a progressive tax system. A progressive tax system collects a greater percentage of tax as you earn more income. Here are the tax brackets for federal income taxes for 2025. A tax bracket is a range of income. You are assessed a different tax rate for each tax bracket. For example, let's say you are a single filer that earns $52,000 a year. You are in the 22% tax bracket. However, that does not mean that all $52,000 of your income is subject to a 22% tax. Instead, the first $11,925 is taxed at 10%. Then the next chunk, up to $48,475, is taxed at 12%. And lastly, the remainder up to $52,000 is taxed at 22%. The calculation for how much income tax is withheld on an individual paycheck can get a bit complicated. There are income tax withholding tables that employers use to withhold the right amount of tax. When you first start a job, one of the first forms you'll be asked to fill out is IRS Form W-4. On this form, you'll indicate, among other things, your planned filing status, such as single or married filed jointly, which goes a long way towards determining the right amount of income tax to withhold. After income taxes, the next biggest tax withholding on your paycheck is FICA. FICA stands for Federal Insurance Contributions Act. FICA taxes are sometimes known as payroll taxes or employment taxes. FICA includes two separate taxes: Social Security and Medicare. Social Security taxes are collected to fund, you guessed it, Social Security. Social Security is a government program that was signed into law by President Franklin Roosevelt in 1935. It is designed to provide benefits primarily for old age retirees. Social Security tax is a flat 6.2% on earnings up to a maximum of $168,600 for single filers. You may see this tax on your paycheck labeled as OASDI, which stands for Old Age Survivors and Disability Insurance. Medicare taxes are collected to fund Medicare. Medicare was signed into law by President Lyndon Johnson in 1965. It is a social program designed to provide health insurance to individuals age 65 or older. Medicare tax is a flat 1.45% on earnings up to $200,000 for single filers. Earnings over $200K are assessed an additional 0.9%. There can be other taxes withheld from your paycheck. These taxes are typically at the state level and are collected to fund specific programs for a particular state. Some of the most common programs include disability insurance, unemployment insurance, family leave insurance, and workers' compensation insurance. So, is there anything you can do to mitigate the pain of tax withholding? Well, as they say, the only certainties in life are death and taxes. Unfortunately, there isn't much most people can do to lower their tax withholdings. One thing you can do is to make sure you fill out IRS Form W-4 correctly. You don't want your employer to withhold more taxes than they need to. And if you have an unusual situation, for example, you work multiple jobs, then you may want to do a bit of research to make sure your withholdings are correct. The flip side of the coin, though, is that you want to make sure your employer isn't withholding too little in taxes. Taxes are supposed to be paid periodically throughout the year and not paid as one lump sum when you file your tax return. If you aren't paying enough taxes throughout the year, you could be assessed a penalty at the federal or state level. What do you think? Does this apply to your life? Leave a comment below, and thanks for watching.